Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. First, I want to say congrats to Billy and Joe. They are our swag winners this week. Remember, we are giving away swag. All you have to do is subscribe and comment wherever you're listening to the podcast. Actually, next week is the last week for that, so make sure you get those comments in. I absolutely love reading them. Today's episode was a little bit different. We spoke to Daniel Lewis. Now, he was a hedge fund manager who was known for being active in some spicy situations in Canada. For those with a long memory, he was involved with Amaya Gaming and Bellatrix, which didn't really work out. But that's kind of the area of the market that he traffics in, special situations and distressed investing. And he still does it for himself and his family office. So we talked a little bit about the art of distressed investing, and he brought us some names that even he acknowledged they could go to zero, but if they don't, he sees 10x upside. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. We all want to make the most of our investments. That's why BMO Investor Line is here. Their easy-to-use platform packed with tools, resources, and commission-free trading on over 100 popular ETFs can help you trade with confidence and take control of your financial future. Start investing today with bmo.com/investorline. Daniel Lewis of Orange Capital, thank you so much for joining me.
Hey, Amber. Good morning.
This is sort of a blast for the past for me because when I was like a cub reporter and reporting on these stories and trying to find a way to make news, I'd always hear about this guy, Daniel Lewis, U.S. hedge fund guy who finds himself in these special situation stocks. How would you describe your investing style and ultimately what brought you to some of Canada's spiciest stock stories?
Sure. I started my career at the old Solomon Smith Barney in a prop trading group in distressed debt. And so there hasn't been a distressed market worldwide since Mexico in 95 through the internet crash and into pretty much anything financial crisis and beyond that I haven't traded, whether it's the debt or equity side. And Canada specifically, as I think some people know, has some pretty unique governance characteristics. And oftentimes it's a bit of a Wild West capital market. And so for us, I always felt that there were just unique opportunities out there. And we also developed some incredible relationships in the legal community, in the advisory community, some really spectacular people. So when you combine that, that really made us opportunistic, I would say, over the years and still follow, the Canadian market pretty actively.
And some of the ways that would manifest is kind of coming in as an activist investor when that was really starting to become splashy in Canada.
Yeah, I think activism is I think as you get a little bit older and wiser, you tend to want to work with the people who want to work with you. And so unless there is an asset value story, it's a really tough way to make a living, I would say. And there's a lot of free riders on that. But I would say when you have a longer term horizon and a plan to work with a great management team, it can be incredibly rewarding. And I think Invest REIT, which was the largest hotel REIT up in Canada at the time that was public, was probably one of those really good stories where I think everybody was excited about the outcome, where we repositioned a portfolio, we added capital, our co-sponsor, which was KingSett, is the best there is in real estate in Canada. So we had a really good plan as opposed to the old school issue a press release about selling your company is not really a way to make a living.
So that never interested you. It was like activist, but almost friendly activism where you try and get the board or management to see, how they could be doing better, still keep their job, still keep the company running.
80% of the time, our engagement was always constructive with people. And so that's certainly the preferred route. And any of the companies I'm involved in today, I have an active dialogue with the management team, and we tend to have a great relationship where we try to offer support, insight, shareholder perspective, but also listen a lot. And I think that's also a bit as you go from young hedge fund manager to a little bit older is doing a little bit more listening and being more selective in how you want to fight.
Well, we're going to talk about that because it doesn't always pan out. And you're so open about that. You talk about the winners, but you also talk about some of the losses that you've taken on. And those, this is kind of a little bit of a history lesson for those that have been in the markets, the Canadian markets for a while, but people will know a name like Bellatrix Exploration, which you were activist in. And ultimately that was not a satisfying outcome.
No, I think I think maybe where I'm unique is I don't mind talking about the losses, because especially I think when you work with younger people, which I do a lot in software or AI businesses that we have, talking about mistakes that you may have made, whether it's underwriting, whether it wasn't listening, maybe not fundamentally understanding industry dynamics, being overwhelmed by macro, being a little more humble. But I think as you do this long enough, you start to realize that you don't need to have an opinion about everything. And you actually, when you look at your numbers, um, you're only very good at specific things. It's a narrow subset. So I'll give you an example. I got some questions from Jillian this morning about some stocks in advance, and my reaction was, I think if I was younger, I would give an opinion. Right, like I know what's going on, and I have a point of view because I read the news and I read the 10Ks and Qs or whatever. But I don't have any edge there. I don't have any insight. So I think really trying to stay concentrated in what you know and say sector focused on where you think you're strong is a hyper important lesson that you kind of learn with experience.
Shout out to our executive producer, Jillian, who does a great job of communicating with the guests and sort of figuring out what's going on, where we're going to take this interview. And to be honest, we could really take this anywhere with you because you've done some incredible things in your career, but you've also persisted in your career. And I alluded, Bellatrix didn't work out, invested, and then ultimately you had to go through you rode an amazing wave, right? You founded your company, it was in 2005.
Mm-hmm.
And then you rode this amazing wave of outperformance, and then you hit a tough year and you had to close up the fund.
Well, it wasn't a performance that why we closed it. I think it was it's the issues, mainly burnout and being tired of the grind and seeing the ultimate consolidation that had to happen in the space. There's been a few great themes in my 30-year career. One of which would be the internet, and the second would be emerging markets and the development story. A third would be the disintermediation of the bank system, which is all these have created tremendous wealth opportunities for folks. But the way that worked is hedge funds spun out, all the prop groups were gone, private equity funds were built, private credit is now the new thing. All this relates to the disintermediation of traditional banks. And so hedge funds have gone through a massive consolidation period. And so running a $1 billion or $2 billion hedge fund as a standalone business is incredibly difficult. And so as an asset class, you step back and you see, what do I enjoy most in my career? What's most rewarding? And at the time we were a pretty mid-sized fund. And so that leaves you vulnerable all the time. So I felt there were other adventures to be had, but the choice to close the fund was actually a personal one.
And how difficult was it? Because you still love to invest. You still invest to this day. What's kind of the main difference? I imagine there's a bunch of differences from running a hedge fund to investing personally now.
I grew up in Buffalo, New York, and I was out with some old Buffalo Bills players and just introducing people, networking, doing some charity. And I think the closest thing to closing a fund is like when a professional athlete retires, because you're so used to sleeping with your phone under your pillow, to just thinking about the markets all the time. That's your identity as a person. Orange Capital was my life. And so you got to figure out a way to reinvent yourself and stay ambitious, stay interested, curious. And I think that's been the really interesting part of the last 10 years is I still love to fundamentally analyze companies. I have a lot to say about, some select names and have done well on my own. I also have a chair of a software company in Toronto. I have a new AI startup. I have real estate investments. And so I actually would say I'm enjoying life, and I don't miss running a big hedge fund.
Let's talk about your involvement in Canada now. Are you as active? Well, you mentioned you were privately active last year in some stocks. Do you own any Canadian public stocks? And what are you doing in the Canadian private markets?
In the private market, I have had real estate investments with partners for many years, mostly in the multifamily space, Toronto core, outside of Toronto as well, other parts moving east. But really led by some very talented real estate professionals who know what they're doing. In the stock market itself, I think that the macro environment in Canada has been so discouraging, and without interjecting too much of my own politics into it, I think the election results and Canada's reaction around the tariffs has really just keeps pushing out the thesis as to when do you really want to get excited about what's going on. But all the arrows point towards Alberta, and there is an incredible story around infrastructure and energy out there. And I just sort of stare at it every day, wondering, when it's going to be the time. So I think that, the data center story in Alberta has yet to be written and things of that nature. But I think there are better places to invest than up north.
It's funny you say that because our markets are at an all-time high. The disconnect between the headlines and what's happening in the markets is stark. I mean, even in the US, the markets are near all-time highs. So I don't know. Should you be taking a look? Should you have been taking a look? Because the market is holding up pretty well in Canada.
Well, I think the Canada market is also, to be fair, is hyper concentrated, right? So, is RBC at its all-time high? Probably should be at its all-time high. But I don't think that speaks to the smaller cap entrepreneurial side of the equation, which I think has been pretty lagging for quite a long time. In the US, it's also like everyone say, well, beta rules and stock picking is dead. I actually think this is an incredible time to be picking stocks because of the consolidation in asset management and then the hyper concentration in the Mag 7. No one looks at some of these stocks, which for me is incredibly fun because you find tons of orphans that are around to look at, and you can generate excess returns.
It's funny. Part of why I reached out to you to do this interview is because you posted on X, does anybody want to talk about stocks anymore? Everybody wants to talk about tariffs and trade, but does anybody want to divorce themselves from policy and politics? Maybe not policy, but definitely politics, and just talk about the markets.
I think distressed investing is still very much relevant. I mean, the markets are always changing if you think about what's happening in credit, but I'll give you some examples. From 2020 to 2022, we had a peak in the enthusiasm over fintech and insurtech. Everybody was going to be disrupted. The scale was going to be, less necessary. And you had all the rise of all these entities funded by tremendous amounts of venture capital. I mean, companies that were worth $1 billion, 2, 4, 5+ billion with rounds of A, B, C, D financing. And their exit strategy was IPO or SPAC. And those stocks all crashed in a meaningful way. And so insurance or insurtech became a massive distress theme for me because there were lots of incredible companies that were starting to create traction who were now trading at 3 cents of their listing price or 3 cents of their last private market valuation. And the insurtech idea of a company that's got an advantage in distribution or in expenses or just general underwriting, that story is great. And it's even better at 3 cents, and it's not very good at 300x from where it was. So I spent an entire year thinking about the property and casualty market, and Root Insurance was an Orphan, which is a insurtech in the auto space, which we still own. Hippo Insurance, which was deeply distressed, which I'm one of the largest shareholders in. Um, really interesting stories. But again, in the distress world where nobody cares, um, you can buy businesses at cash value that still have incredible upside. So that's how I would think about the problem in stock picking. And, the mortgage origination, fintech, all of that stuff, the same goes, is that look at what gets thrown out by venture funds who have got no real business owning public securities and no real sponsorship in the institutional market, and you can find lots of value. But those are a little bit small for what Orange Capital used to be, and for some of the big pod shops, you need more liquidity than that. And I think that's where the fun can be had.
Well, and a high risk appetite too, right? Because there is an art, maybe a science to distressed investing. You don't want to buy something only to see it go bankrupt and your invested dollars go to zero. Over the course of your long career, can you distill what is the art of distressed investing? What are the things that a company needs to show that this is worth putting money into, that there is an opportunity? I think about Carvana as such a poster child for that, right? Near bankruptcy, at least that's what everybody said. Some people quibble about whether that was actually true, and then just explodes to the upside. So you can make so much money, but there was tremendous amount of risk there.
I think the answer on that is, if you're going to buy a stock that can go up 100x like that, and that's the speculation you want to have, you need to be prepared for it to go to zero. I mean, there's no such thing as the secret drawer that I have that says it's got 20% downside and 40x upside. That's just not how the world works. I can give you an example of something like a Carvana that I've been involved in lately that I think has those characteristics. That helps. Is better mortgage. You want to talk about that? But I think having a macro thesis around a growth tailwind behind the business, I think, is really important. I think balance sheet is super important because you need to understand liquidity and solvency. How long do you have to see if the thesis can play out? All those things kind of, and what is the quality of management is obviously number 1, 2, and 3. And I think people always miss that one, especially people who are less experienced, is the quality of management is 1, 2, 3, 4, and 5 in the story. If you're going to buy a distressed equity and you expect it to work based on operational integrity and excellence.
I want you to save the Better Home chat because we're going to talk about that in your pro pick segment. But I want to pick up on this idea of orphans or sectors that were left basically for dead. There's a lot of those class of 2021 IPOs when everything was great that are well below where they were. I mean, we got a number of them in Canada.
Oh, I can give you the other one I've been thinking a lot about is commercial mortgage REITs. Commercial mortgage REITs are historically a retail product in the U.S. market. And the way that they're structured is that you have a sponsor, like any REIT, whose primary role is to lend on a first mortgage basis to multifamily, office, hospitality, some land. But generally, they're a first lien mortgage lender, and they borrow against that using secured credit facilities, warehouse lines, or corporate debt, and they raise equity in the market, and they earn a spread, and that spread becomes a dividend yield play. And those stocks trade at 90 to 99% of book value in a normal environment because they'll pay out a nice high single-digit dividend. And then when there's a disruption in a market, whether it's housing finance, commercial real estate, the bond market, these stocks become vulnerable as defaults pick up, dividends get cut, and retail investors don't know how to handle a dividend stock that suddenly has underlying solvency volatility. And so they can be trading at the bottom of the cycle at 20, 30% of book value. That's a great space to hang out in. And I think where we are in places like the commercial mortgage, the commercial real estate market in the US, the down cycle is pretty long in the tooth. Office has been down for a long time and it's on its way back. And multifamily will ultimately pick up. Replacement value is only growing higher. So that's another place where, again, it's not as sexy as talking about NVIDIA, but who's got a unique take on NVIDIA, and who cares what I think about NVIDIA? And similarly, it's like, what do I think about Meta, or what is Google vulnerable or whatnot? Like, all those things are fun to talk about, I guess. But if you actually want to make money and get to know management teams and roll up your sleeves and try to generate risk adjusted returns, you don't want to be looking where everybody else is looking.
So that's interesting. Does your approach, is it always in the smaller cap areas, under followed, under covered? Because I can think of a lot of areas, healthcare, for example. Think of those vaccine makers that are under tremendous pressure, that, Pfizer unsuccessfully got some activist attention, but it didn't really do much. United Health, such a large company to be down and out. Is that at all interesting to you?
I think you stick to it's not the market cap. I think Rocket Mortgage is going to be an incredible story. That's a large cap company, with some of the changes they're making in their business structure, and just exceptional visionary CEO. Progressive Insurance is just a must own in every portfolio. So sure, there are larger cap names that I follow that are super interesting.
There's so much distress out there in the large caps, not distress in the sense that you talk about, like a existential crisis, but like a United Health, a large cap like that isn't supposed to fall 50% in the span of a week. A Pfizer, with all of its drugs in its pipeline, trading like it doesn't have a hope and a prayer.
I think with those types of names, was United Health, of course, in my hedge fund network is a source of a lot of discussion. It's similar to lessons learned in, say, Bellatrix, you mentioned before, is industries that you really need to be an expert on. If you want to go trade energy stocks in Alberta, you better know what you're doing, because there's some real adults in the room who know how that space works. And similarly, when you start talking about healthcare and health insurance, and you think about the headline risk that comes with Medicare reimbursements and all the different policy changes that can come into play, you need to be an expert in that field. It's very difficult and very tricky to do. So again, I think my advice is always to figure out where you generate the highest returns and focus on those sectors. So I have lots of thoughts about United Healthcare, but none that I would articulate in a financial investment, because I know one of my first experiences working in distressed debt was being handed nursing home junk bond files. And there was a time that nursing homes in the United States junk market were considered the safest place you could invest in high yield, until reimbursement rates were changed and every single one of them went bankrupt. And so those lessons that you learn early in your career about, could I have understood that risk being priced into it? So people running to figure out United Healthcare, again, I want to make sure that I have some sort of insight into the health insurance market. And the way the U.S. health insurance market works, I think very few people have that at all, if anybody.
That's a lot of I feel like the amount of war stories that you have on things that have gone sideways, like when you're in distress. Do people get that? Like when you're in distress land, is this kind of par for the course? Is it sort of like VC investing where well, it's 90% is going to be failures?
It's like looking at, I don't know, Hertz is making a thing again, right? And how many times have I looked at a rental company in my career and seen them file for bankruptcy or recapped, or this time is different, or whatever it is, where you just look at it and you go, that's just a horrible business. And businesses that destroy capital that you think fundamentally deserve to be disrupted and destroyed by newer ideas. I mean, sure, maybe that's a levered equity that's going to have another run in an upcycle, but it's much more likely to have to file and restructure or dilute, because it's a fundamentally bad business. And I think that's one of the things that distressed is very interesting, in that you spend so much time in this sandbox of looking at these lousy companies, and then you pop up and you look at companies that are addressing the problem or doing it differently. So would you rather own Toro, which is a company that uses other people's cars as a rental product, no assets on the balance sheet, modern tech stack, it fits the modern demographic, doesn't have to stack these cars at an airport, which everyone knows is an exhausting experience to pick up a car? Would you rather do that? Or you want to recapitalize Hertz for the 12th time? And so I think, obsolescence risk I could give you a ton of stories about that, but I think that I think more than ever in the environment, traditional investors are not pricing in the how fast the ice cube can melt and the obsolescence that's coming with AI. And
I
Hertz would
mean,
be a perfect example of a company that, when you think about self-driving, you know, all the opportunities going out there, and the amount of core infrastructure that they have to maintain on a business that doesn't even have a reason to live in 10 years, that's how you want to spend your time? I can do better.
you know, it's interesting. You mentioned like the downside coming from AI. I feel like the market is super thirsty to price in the upside.
Mm.
And it sounds like you're saying, but maybe ignoring the risk. But like, is it right to ignore the risk? Because you don't really know how fast it's going to move and where it's going to show up.
I think that's why financial leverage is actually becoming more important in the long term. Whereas there was a long period with low rates where optimal balance sheets really carried the headlines. But the problem with a lot of debt is, if you don't have money to invest in new technology and you don't have the vision of the executive team to invest in people who understand, you could lose your seat at the table faster than ever. And so the idea that a lot of these zombie companies are really more melting ice cubes that can hit a wall, I think is not well understood. And I think more when you talk to people in the venture world, or you sit down with college grads building startups and you see what they're capable of doing with such little resource, I think that is an existential risk to the private credit, leverage buyout, private equity world. And the new barbarians at the gate are going to be the ones who understand AI as a way to drive operating efficiency rather than optimize financial leverage. And I think about that all the time.
And it seems like you're saying that maybe people are a little bit, do you feel like they're a little bit sanguine about it, that they're not really paying attention to it?
I think it's really hard to ask somebody who's got, experience in running private equity or private credit to understand the latest fast moving changes in technology. I mean, I can't say that I understand it completely either, but it is important to get a tutorial, I think, and get your hands a little bit more dirty with it so you can grasp like how fundamental this is. And I think that in the race for just never ending assets under management, and the ease to just fund AI infrastructure as the answer, I think people might be missing the point on traditional companies and what this could mean.
For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 250 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary products to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. You know, we've been in such a bull market really for the last 15 years. If you want to exclude that little blip in the pandemic, which I guess technically started a new one. But it sounds like you haven't really, and people complained about zero interest rates and these zombie companies existing because that they were propped up by either low interest rates or government spending. But it sounds like you have not found a dearth of opportunities in these kind of areas that you specialize in, whether it's distressed or special situations.
I think there's nothing more exhausting than a market strategist talking about timing the market than a hedge fund manager calling for doomsday about the market, right? Like, who cares, right? I wrote a new book and the end of the world is coming because of fiscal irresponsibility, or, no one cares, which I no, we can talk about it, but it doesn't make you money. I think there's always interesting things to do because capital markets tend to overcapitalize certain ideas and then they undercapitalize those ideas, and trying to be opportunistic around that. There's always exciting things to think about. The end of the SPAC boom was really fun because you had interesting companies trading below cash value that had a reason to be around. And so you would say SPAC and everyone would go like, they'd start running for the hills. Well, yeah, a SPAC at a $10 issue price, is not maybe that interesting, but at like 20 cents, and so again, I think just by the nature of capital markets doing what they're doing, there's always something interesting to learn about.
So did you pick up any of those SPACs that got thrown out?
Sure.
You want to tell me which ones?
We did a recap deal for SoundHound, a preferred share deal, it was a 14% coupon at $1 a share. And that was a voice AI company. I've since exited that position. Talkspace, which is a mental health company. Mental health became, again, overcapitalized. Remember COVID, everybody was talking about Zoom doctors, Zoom therapists, Zoom whatever, nutrition, and that became a massive bubble. And then Talkspace went public as a SPAC, and then was trading at a minus $100 million enterprise value with all its cash on its balance sheet, and hired a real CEO who started thinking about generating returns and proper margins for the business and scaling the business, and the business had a pretty good has had a pretty good run. So that stock's went from 60 cents to $3. I mean, that's not bad.
Do you have a preferred way of entering these situations? Like you mentioned for SoundHound that you were involved in the recapitalization. Is that always how you're working in these situations, or do you ever just like straight up buy the equity?
Like Talkspace would be one where I just own the equity. Hippo Insurance is just on the equity. Better Mortgage just on the equity.
All right, well, let's get into these names because you've name dropped them a little bit. So let's jump into your pro picks, distressed ideas that maybe have some upside opportunity. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
One I would have is in the commercial mortgage space we talked about is ticker CMTG, Claros Mortgage, which, again, disclosure, I do own. This is a mortgage REIT whose primary exposure is to multifamily apartments. They have some office, they have some hospitality, they have some real estate that they've taken over in a foreclosure. And you have basically a business that's around $6 billion of assets, a couple $100 million of liquidity, a book value of about $13 a share and change, which is going to be well north of $1 billion. I think it's about $1.8 billion. And it's trading at 20% of book value. Stock's around $250 or so.
So this is a class of 2021 IPO.
This was an IPO in 2021 in commercial mortgages. They are
well off of where it went public, as you mentioned. So like, how do you claw back?
So what you have to think about for these kinds of companies is, what does the asset side of the balance sheet look like? Have they marked to market appropriately, and what other reserves they're going to need to take? About 40% of their loans would be qualified as what they categorize as 4 and 5 risk. 4 is in workout, not still cash pay or accruing. 5 is in default, whether for foreclosure or the loan to be sold to a distressed buyer. And so that size of their portfolio is what has investors concerned. They've already taken over $200 million of reserves against that portfolio. I think that's probably light. But when you start to sensitize the various components of the book, multifamily, office, and so on, when you're multiple years into a down cycle, the company could triple its reserves from here. It could be over $600 million. And we think that's probably the highest end it gets. And the book value is still around $10, $11 a share. And this stock's at $250. So for us, anyway, for me, I think of it this way. A bad mortgage REIT will typically trade at 50% of book. A stabilizing mortgage REIT will trade at 70 to 80% of book, and a great one will trade at 80 plus. And in an upcycle, they trade much closer to par value. The reason why the stock also is orphaned is because the number of bad loans on the balance sheet, they stop paying a dividend. And these REIT stocks, as we all know REITs are, tend to be retail oriented. And so when you have a dividend stock, that is now got balance sheet volatility in it, there's no natural owner for it until it stabilizes. So you see a stock trading down here, but again, 20% of book value implies a massive dilutive event in equity issuance, which I don't see a reason for. Or a bankruptcy, something like that, which again, I don't see a reason for either. So as they continue to just roll off the bad loans on the book, you'll start to see book value stabilize, and eventually the stock should trade at 70 to 80% of book value. And that's, $7, $8 a share, which I think is a great rate of return. It's just
Yeah, it's
for
trading at
people.
like 2 and change now.
Yeah. So for people, I think it's just uncomfortable to own that asset because what happens to the bond market? What happens to commercial real estate? But when you're, 4 years into a distress cycle in commercial and you've taken lots of pain already, it's actually a much safer investment here to me than it would be buying it at its IPO price of 15.
Does it need a rate cut?
No.
Like, is that a catalyst? Doesn't matter.
I think also you think about who are the natural exits for their existing bad loan portfolio. There was a story yesterday on the tape that KKR closed like a $40 billion mortgage fund. Every distressed fund or private credit has been raising distressed real estate money for commercial mortgages. And the amount of dry powder on the sidelines is enormous. Blackstone, KKR, Apollo, Ares, all of them. And so for me, at least the way I look at it is their natural exit are people who are being selective. Maybe the tariff thing has delayed the recovery, but there are natural exits for these types of workout loans. So I don't think you need a rate cut for the thing to work. And I think it's priced for just horrible outcomes that are unlikely.
Okay, so mortgage REIT, you mentioned this is an area that you like. Another area that you mentioned is insurance, and this is where we find Hippo Holding. And I won't pretend to know much about this stock. It's a small cap, 600 million. Another class of 20. This one, I think, went public in 2020, right?
Mm-hmm.
And has done very poorly. And so enter Daniel Lewis, and what do you see?
So Hippo is an interesting story where I think that there's an asymmetry in the risk profile. It's seen as an insurtech in the home space, but underneath the surface, what Hippo owns is one of the leading fronting insurance companies. And to explain what that means, the world of specialty underwriters, people who have a unique take on school bus insurance or wildfire insurance. These specialty underwriters don't actually have a balance sheet or a licensed carrier. They will underwrite this stuff, and they need an insurance company to actually have the paper in either a regulated or the E&S market. So what Hippo will actually do through its subsidiary Spinnaker is they earn a riskless fee for having an insurance company where these specialty underwriters write in the various different states. So they earn a 5% management fee effectively for running these programs. And what's interesting is it's a way to grow a business in insurance where you don't have to build all these unique niche specialties. You actually are partnering with these underwriters. So they do the front end underwriting. Spinnaker has the regulated paper, and then the risk is transferred to a reinsurer on the back end. So they're actually much more resembling of a fee-related income story than they are a traditional insurance company. They do take a small amount of risk, but short answer is Spinnaker is on a path to do this year. It's more of a normalized $35-40 million run rate of operating income. They have no taxes because of NOLs, and that business, based on just volume growth, can grow to probably 70-75 million of income in the next couple of years, which is just too cheap on a market cap that is 600 million. Hippo also owns a home insurance underwriting business and a home agency business and has excess cash. So when you start to layer those in, and Spinnaker becomes the forefront of the story as to what people see Hippo, which was a home insurance company, I think they're going to look at the company very differently.
Has it been in the penalty box because just housing in the U.S. in general, it's been sluggish?
I think property and casualty went through its own version of Lehman in the last couple of years. At the end of the housing boom, coinciding really with the boom in insurtech, you had the explosion in inflation. And insurance companies hadn't experienced that since the early 80s. None of them were prepared with rate filings to increase insurance rates to offset the inflation. So you had more wildfire catastrophic events than we've ever had before. You had inflation, which broke the economic models. And then you had insurtech be overcapitalized by venture all at the same time. So really a hat trick. And so everybody in the industry lost money. And then anybody who was new at underwriting, including Hippo, lost even more. And so I think what we've seen in the last couple of years, anyone who has insurance has found, is that auto rate adequacy has come to the market. Home rates have gone also up significantly. So you're now in sort of a different cycle than the macro world, where rates are at a place where auto insurance companies are actually making significant amount of money. Home, I think, is going to continue to follow that. So it's not really about the home sale, origination, purchase, refi market. It's really about, is the risk adequately priced in that space?
What do you think then is like, does a recovery look like for Hippo?
I think what Hippo has an analyst day coming up in like a week. And I think what I'm hoping management's going to do is start to show it's less about a home insurance company, either a originator, and much more about this specialty fronting company, which is a more stable fee-related income story. The multiple of a subscale home insurance company with extreme volatility is going to be a single-digit multiple of a underwriter that's got exposure to great auto, unique Spanish speaking auto, to wildfire, to casualty markets, all these sort of unique underwriting places where they get to earn a fee for placing that paper. I think that's is a high teens type of multiple business. So as people start to realize that it looks much more of a fronting company than it does a home, that the multiple of the business will change, and that the share of revenue of the company is going to go from home insurance to the fronting side. So we'll see what they have to
Okay,
say about it, but that would be my that's really my hope, or I think direction where they're going.
your third pick, kind of on brand here, another pandemic-y IPO that has gone south in mortgages, Better Home and Finance. SoftBank is a big owner in this one. I think they own about 12%. So at some point, it was interesting enough for SoftBank.
This one is fun. You asked about Carvana earlier. You were mentioning, what's the next Carvana? And I was like, well, where's the magic folder? Better is the only stock I own that I think could run out of money in the next 2 to 3 years. Unlikely in my mind, but has the potential to be Carvana. And I'll sort of explain why. The mortgage origination space was historically dominated by banks. After the 2008 crisis, banks have exited the business, regulatory requirements, servicing capital, and you've seen the rise of groups like Rocket Mortgage, which is a tremendous company. Better started during that period with the idea of making or refinancing your home a lot more of an easier process. And I think a lot of it was just done by offshoring. And they peaked at originating over $50 billion of mortgages in 2021. It was a venture capital darling with a very, I would say, passionate CEO, and had funding from folks like, Goldman Sachs. So there's all the typical late stage fintech stories, right? The banks all pile in at the end, or the insurance companies all pile in, and of course, the big king of that would be SoftBank piling in at the end of that story, and when you had the rate market change, Better mortgages went from over $50 billion to, I think like last year was like $3.5, $4 billion of run rate. So
Wow.
the CEO is infamous on a Zoom call for like firing like 1,000 loan origination officers. And I'm sympathetic to that point of view. Anyone who's run a business during COVID and loses 95% of their revenue when they have a fixed cost base is a tough spot to be in. Eventually, what Better did is been cutting costs and was able to list via SPAC. The SPAC was a disaster. They had a bunch of debt from SoftBank. And so I think it did a 500 for 1 split. So the stock is trading at probably like, I don't know, like 20 cents of its $10 issuance price. But along the way, Better to me is actually the AI trade that every venture capitalist is trying to find, which is AI and automation as a foundational layer of a true operating business. It's not a software company. It's not selling trinkets or, I'll sell you a synthetic agent program for your company. Write me a subscription fee. They made AI the foundational layer of how they underwrite mortgages, meaning 24/7 loan officer. You can call up the phone. You're talking to an AI loan officer. The underwriting part, which they call Tin Man. Betsy's like the agent. Tin Man is the middleware. They can give you a rate lock in like a day. And I don't know if any of you in the States or a few what it's still in Canada, but try to get an interest rate lock from a bank in a day. And so the fact that they have been able to use the downturn to become a AI layered company to the point where their profitability is going to be like in the 6 to 10 billion of origination layer. So you don't need a full recovery. But so the point of what they are is they're the AI story that everybody's looking for. Do they have enough capital to get them to that place? And they're
Are
getting to a
they,
place of cash flow positivity.
is AI good at underwriting? Like, is the credit quality
Yeah,
sound?
they write a product that is actually pretty is the conforming mortgage. So it's a Fannie product.
Yeah.
The other is they have new ways to grow, which I think are really interesting. They were originally a direct-to-consumer mortgage company where you go out and you advertise the internet. That's how they got all their volume. That is extraordinarily competitive and really a broken business. Finding new ways of distribution is the other survival. And what they've done is partnered with Neo Mortgage, which is a mortgage broker who has professional people who are now using Neo powered by Better. So they're white labeling for those loan officers. And if you ever talk to a salesperson, if you can make their job 10 times easy so they can work on customer as opposed to back office, that's a great growth trajectory for them. They're also white labeling this AI solution for banks. So there's no reason for a small bank to create their own mortgage origination department. They should just simply white label this service. They have that now out in the marketplace. And so for them, I
Except,
think then they have a HELOC product, which is home equity lines. So to me, this company, and finally, they just restructured their SoftBank convert, where SoftBank took a 50-cent haircut. They've got tons of runway. Their cash burn is coming down materially. So as they hit this inflection point, which is a lot like Root Insurance or some of the other Carvana, you can start to see why this company was actually worth $5 billion at its peak instead of $150 million now. They have a unit economics advantage. They have a really good story. They are a great takeout target. They're a great growth story. And so for me, it's one of those stocks where I look at and say, I can actually underwrite a path to them doing a couple $100 million of earnings over time. And I think they've got lots of runway to make it.
I was going to ask about a takeout potential because, yeah, a bank that doesn't have any of this technology seems like they would do that just to kind of buy the technology. But I can't get, and it sounds like such a great story. Who doesn't want the next Carvana? Except I remember you said it could still run out of money in the next year or two.
If you talk to management and you listen to what they have to say, I think that they're moving to a place where cash burn is going to be running at less than $20 million a quarter, certainly by year end. And I think that they're going to be close to break even early next year. So if that's the case, then the option is extended well beyond 2028 in my mind. So, but you can't buy stocks that you think could be 30 to 50x that can't go to zero. There is no world where that happens. So you size it appropriately in a portfolio. But this is just one that I look at and say every venture capitalist is looking for AI native operating companies. This is exactly what everybody wants to find. And if this company was private, it would probably have a $2 billion valuation on it. But because it's an orphan equity that was gone public by SPAC, you're buying it at a fraction of what its private market value is, which tells you how sort of confused public-private markets are at the moment.
We could have just done a whole podcast on that.
I think it's a really fun area to think about. But I do, when I talk to Better, I'm like, every venture capitalist I know is looking for this company. And by the way, it's not like they're subscale. They did 800 million of volume last quarter. So it's not like some startup with two kids in a sleeping bag,
Daniel, it was a pleasure catching up with you again. Thank you so much for being with us.
Great to see you, Amber. Hope this was fun for you. It was really fun for me.
It was great. Thank you. That's Daniel Lewis joining us of Orange Capital. Make sure you stay with us. Our next episode, we've got Ross Healy on the show. Now, he focuses on North American large caps. He's with Strategic Analysis Corp. You can get your emails in questions@inthemoneypod.com or anywhere on social media. You can find us at InTheMoneyPod, and we'll see you on the next episode.